we're at a time where the market hasn't been performing in a fantastic positive way lately. In fact, some of the indices are very near what would be considered a correction, which would be down, roughly 10% from their highs. And so emotions tend to get pretty heated when you see big gains and big dips, and we're kind of in the big dip territory. So the question is, how should you react to market volatility?
So you posed that question in an interesting way. You said, how should we react? And my answer would just be, don't. I guess is the best way I can answer that in one word. To elaborate a little bit is reaction involves emotions, which is something that shouldn't be involved when you're talking about the stock market. So, and we all have a tendency to feel that way because we're human. So yes, the market is in a little bit of a correction phase. It's volatile. It's going up. It's going down. It's making big swings. I don't have a glass ball or a crystal ball. Nobody else does. So we don't know what tomorrow's going to bring, what next week's going to bring. But what we do know in a time like this is don't panic. When you see the stock market go down, I think one day last week it went down 700 or 800. It might have been almost 900 points by noon. And, that was, a lot of people probably panicked and thought they should sell. Well, by 4 o'clock that day, a few hours later, it was in the plus. I think it ended up the day in the green. So that just goes to show you how quickly things change. But even if it hadn't gone positive and ended up in the green, even if it was down 900 and the next day it was down 900, as long as you're taking a long-term view, which is what you and I always discuss, we're not speculators, we're not short-term investors. So for us, that doesn't matter. And actually, let me walk that back a little bit. It does matter a little bit, but the way it matters is we're going to hold our positions, but we're going to put more money in the stock market and buy the dip is what we're going to do. So that's what I would advise.
Well, that's good advice too, right? Because I think there's sometimes wisdom in going against the crowd. Sometimes there's wisdom in going with the crowd, but in a case like this, when people are reacting emotionally, look for opportunities, because people are very often guided by their emotions and their feelings. And so they see that the market is down 900 points or 5% or whatever. And so they figure, well, there's no telling how low it's going to go. So let me get off this train. And they sell at the dip.
Yep.
Well, I was listening to Ben Shapiro, and he was quoting Warren Buffett from back around the financial crisis in 08, 09. Someone had asked Warren Buffett how he felt about the market losses, on his net worth or whatever. And he was, this is paraphrasing, but he basically said, I haven't suffered any losses because I haven't sold anything.
Exactly.
And that's important to remember. And it works both ways, right? You haven't realized any gains until you sell, and you haven't realized any losses until you sell. As of right now, you just own however many shares of whatever companies you own, if you're involved in the stock market, and that's what you have.
Yep.
So, the relative value of that isn't realized until you actually pull the trigger and sell. But like you said, if you change your frame of reference and you change the way you look at things, where other people see panic and fear, you see opportunity.
Yeah.
And look at the history of the market. I mean, there have been times like, the stock market crash of the 20s, where things went from really high to really low, and it took a very long time to recover. But if you look at the entire lifetime of the stock market, even including that period, the stock market has performed very well. The real estate market has performed very well over extensive periods of time. So we've talked about this before, but I think it bears repeating in the context of this conversation. Whatever you feel about the situation, kind of pull back a little bit, take a bigger view, and see if that changes your frame of reference. See if that changes the way you feel about it. Because you might look at it in the context of 2022 and go, oh man, January was brutal. I'm down 8% in the month of January. Back it up a little bit. How are you since the start of 2021? How are you since the start of 2020? What's your 5-year performance?
Yep.
You might have had a bad month, but you haven't had a bad 3 years. And when you realize that you're up like 30 or 40% over the last 3 years, you're going to feel a little bit better.
Well, you're 100% correct. And there's a couple rules and stuff we abide by that we've discussed on previous episodes. So first off, you should have a diversified portfolio.
Right.
Then you really shouldn't be in too many individual stocks. Probably mutual funds kind of shield your risk level there. But unless you're really involved in it and you really put your due diligence in it, and then you can be in individual stocks, but that takes a lot of time that most of us don't have. And not only that, there shouldn't be money in the stock market that you need 6 months from now. So even if the 20s, it was, it came back a couple years, went back down, and then it was 3-4 years at least, I think, before it started coming back. Well, that's why we say, if you need that money within 5 years, it doesn't belong in the stock market anyway, right? So now that we've gotten past that, if that money is in the stock market and we've had a 15-20% correction, who cares, right? What does it matter to you? If it doesn't matter to me, I'm not using that money right now. I know I don't need that money to live. I don't need the money to pay my electrical bill. So that's what investing is all about. If you need the money, that's not investing money. That's money you need to cash flow to pay your bills. So that's something that really makes a world of difference, I think, when you can separate it like that, and you can internally tell yourself, well, this money's going in there and I don't need it for 5 years. So if the market goes down, what does it matter? Why do I all of a sudden need to pull it out? Because your dynamics don't change, right?
Right. Well, and one other thing I would add to this conversation is, remember the reason you made your initial decisions to begin with.
Yep.
So if you say have some money that you want to invest in the stock market, you're going to have an idea of the kind of performance that you would like to see over a certain period of time. So if your period of time is 5 years, and you're looking around and going, what can I do in 5 years if I say buy bonds? Or what can I do in 5 years if I put it in a savings account or a CD or a money market account? And you're looking around going, okay, well, 0.6% over here if I put it in a savings account.
Yep.
Or 2 to 3% if I put it in a bond, or 7 to 10% if I put it in a stock market fund. And so that's what you do. You put it in a stock market fund. Well, if you did that 2 years ago, you're looking at this and going, man, over the course of the last 2 years, I'm way ahead of schedule, most likely. So yeah, it might have been a bad month, but if your entire point in the beginning was, I wanted to make a 7% return over 5 years, look at where you are on that. Now, if you're 2+ years in and you're way behind that curve, I would say it might be time to evaluate whether you need to change your strategy or not.
Yeah.
But don't do it because of the performance of 1 month. make that decision based on a larger time period where you can say, okay, I assumed that by investing in this fund or in this sector or whatever, that I would have better performance than I realized. That warrants a change of course. That warrants me doing something else. But saying, oh, well, the month of January was rough, that warrants a change of course. That's probably not a good idea.
Oh yeah, you're 100% right. You can't look on that. You can't react on such a short-term event when you're talking about because for most of us, it's a retirement account. We're in our 20s, 30s, 40s. Even in your 40s, you got 25 years before you're going to need it. And another aspect of that is you don't magically need all of your retirement account once you hit a certain age, right? You're only going to take a percentage of it every year, and it's going to continue to grow. So even if you're in your 40s, that money's going to be in there for 40 years if the average life expectancies and person lives to their 80s. I want to give you an example. And I was looking at a screen. I've got my monitor, another monitor up, kind of tracking some of the movements in the after hours of the market. This is just an example. I don't endorse this stock whatsoever. So for anybody listening out there, this is an endorsement for them. But Facebook or Meta platforms, or I think they're called now. But anyway, I think they reported earnings today from what I can gather. And after hours, don't quote me on this, but their stock is all of a sudden down after hours, somewhere around 25% right now. It's they were at 323. I think they're in the 240s right now. And when I see something like that, now I'm not saying, like I said, just full disclosure, I have no idea. I haven't read this specific article or done my specific due diligence on this specific stock. But in most cases, you see something like this happen and you go, wow, we have this company that's done well for 15, 20 years. They have a 20-year track record. And then all of a sudden, overnight, they just lost 25% of their value. Is that legitimate? You kind of say to yourself. So you need to do your due diligence and your research, but that's a pretty small chance that any company just woke up one day and said, wow, we were worth 1 million today and now we're worth 750. That's a big drop, when they have such an established track record.
Right. And the odds are, even if they were overvalued when they started the day, they're probably not 25% overvalued.
Exactly.
That's where you look at it and go, I think emotion might have gotten the better of a lot of people.
Well, that's it.
Maybe now's the time to do some research and find out if it's a good time to buy, right?
It might be. I've never followed Facebook when it comes to stock investing, so I don't know. But it could be. I mean, that is a substantial drop, and it's not very common. 10%, yeah, that's correction territory. 25%, that's not a typical earnings miss to cause that.
Yeah, I agree. If you didn't know the name of the company and it was just abstract company A,
yeah,
you'd look at that and go, yeah, they probably didn't legitimately lose 25%. They probably weren't overpriced that much, right? So what's the reason for this other than emotion?
Exactly.
Look into it a little bit. The fundamentals may not be there. There might be some significant issues. If that's the case, you'll find out. But if you see this happen to abstract company A, you might also find it's a good time to buy. So
yeah. Well, and that's what I use these times for, right? And that's what you and I talk about a lot. And we said that earlier. So I think the market's going to be a little more volatile in 2022 than it was the past 3 years. I don't know what it's going to end this year. Nobody does, but I think there will be ups and downs. So the best advice I have for that is just hold on. Don't overreact. Don't panic to the money you have in there. But there will be buying opportunities for certain investments at certain times if you're paying attention. So just keep your emotions out of it. And at the end of the day, even if you don't buy more because you don't have extra funds lying around to buy a dip, that's okay. There's nothing wrong with that. Stay the course. As long as your investment goals and strategies haven't changed and your needs and your wants haven't changed, stay the course. And at the end of the day, you're going to be fine.
The Purposeful Podcast.